Way. After the break, we'll talk more about hedge funds, but in a different light, redemptions and how some hedge fund strategies have done. Charles Gradante of Hennessy Advisors, next on Taking Stock. Welcome back. Sentinel Management, the Illinois-based group that manages about $1.5 billion, and not to be confused with Sentinel Mutual Funds, moved today to hike client withdrawals. Firm said it was a victim of panic withdrawal by investors because of subprime mortgage defaults. Are more redemptions likely? And what strategies of hedge funds are outperforming the markets right now? Joining us, Charles Gradante, managing principal at Hennessy Group. Thanks for joining us, Charles. Important to note, Sentinel Management, not really a hedge fund, right? It's a money market company.
Money market fund.
Does it worry you more, though, than a money market?
Yes.
Companies having these problems than a hedge fund?
Money markets are supposed to be AAA credits. AAA credits, but they have underlying instruments, many of which were mortgage related, that were AAA rated.
And therein may be the problem.
In the belly of those
AAA rated,
were
right?
some that were AAA rated. And in the belly of those instruments were some toxic subprime instruments. So yeah, money market having a problem like this is shaking up the market again.
You know, think about us here. We don't report any rumors, because if I just reported rumors, I could be busy all day with people sending Bloomberg messages around like, this hedge fund's in trouble, so-and-so. Are there hedge funds out there that are in trouble?
Yes. Yes, but first, let's break it up into the good news and the bad news. The good news is the Hennessy Index, which is on Bloomberg, was up 9% through July. Through the middle of August, we figure hedge funds are up 8%. That's a balanced portfolio of hedge funds.
It's not bad.
While the S&P is up 70 basis points year to date through the middle of August. The strategies that are getting hit the most are the strategies that are highly levered. And those typically are your market-neutral stat-arb strategies, your currency strategy.
Okay, market-neutral, I understand. What about stat-arb? Explain that to our viewers.
It's pretty much similar to market-neutral, where they're computer-driven strategies, where, if I can use my hands for a second, where the...
No, you can't, because I never use my hands.
Well, I'm Italian, so I have to. Where the computer is coming up with stocks to short, and stocks to go long, and they're playing reversion to the mean, and they make money when the statistical relationship between the shorts and the longs revert to the mean. What's happening now is shorts are going up and longs are going down.
They're getting killed on both sides.
So they're getting killed, and they have leverage 4, 5, 6 to 1, sometimes 10 to 1.
Well, that's not good.
That's what's happening to the marketplace, and they're dumping mostly big cap stocks onto the marketplace that have nothing to do with the credit crisis or liquidity crisis, like Caterpillar's down. You know, everything that's.
But people that are pure short might be doing very well.
They're doing very well. They're one of
guys
the
like
best.
David Tice out there, you know, who's probably dancing.
David's having champagne tonight.
Yeah, in St. Thomas, wherever he might be, exactly. But it's been a while. I mean, listen, the market's gone up. The short sellers may be finally having their day.
Yeah.
So are those the only strategies that are working pure shorts?
No.
I mean, if your mean of your index is up 8%, that's pretty good considering what we've seen in the last couple months.
Yeah. What's working well are international. They're up 11%. Emerging markets up 11% through July, and technology is having a very good year, both on the long and short side. So most of the strategies are positive. The strategies that are negative are your arbitrage strategies. Convertible arbitrage is like up 4%. But strategies where there's leverage.
But if these deals reprice that we're hearing about, all the deals that have yet to sell paper for but are out there done, if they reprice, aren't some of these ARBs going to get smacked?
Yes. There's about $300 billion in the pipeline to be repriced. Once they reprice, and it's going to be repriced down, that will cause a mark-to-market across the industry, and there may be another shoe to drop. I think there will be more shoes to drop because of this. I don't see this problem of deleveraging going away until the rest of this year.
You know, I know there's firms. I know the one strategy that's been working great is people who've been betting on subprime failure. Heyman Capital out in Dallas, Texas. Paulson here in New York, they're up huge because they've been buying insurance, betting that subprime is going to get worse and that spreads are going to widen, and they've been making huge. What other strategies, though, besides that are working right now? International and what else?
Emerging markets and technology, long-short equity. But those long-short equity managers were also long the credit default swaps, and they were betting that spreads would widen and the CDS would go up in value, and they have done
All right, I'm glad
well.
you're here. I need you to answer a question because, of course, the other day the top story, Goldman Sachs' Global Equity Opportunities Fund, which was down 20-some% in about a week or two in August.
6 trading days to be exact.
Which is just mind-blowing in its own right. You know, they got $2 billion from Goldman, $1 billion from outside investors. You know, various media calling it a rescue, a bailout. Goldman Sachs, very quick, say it's not a rescue, it's not a bailout.
Yeah.
They see value, they're putting money in. Was it a bailout?
No. I think the fact that they got Greenberg and Eli Broad and other people, Perry Capital, to come in and put up $1 billion, they would not be a part of a bailout. Those guys want to make money. And I think Goldman purposely had outsiders come in to prove that this is not a bailout. What they have now is a cachet of enough liquidity to take out every limited partner out of the fund and take the fund in-house, private.
Almost take it private.
Take it private. And then
to avoid redemptions. Or people wanting redemptions.
Actually pay the redemptions out. Take the fund over. In other words, if everybody wants to redeem, here's $3 billion, you're out. Now it's a Goldman Sachs, Perry, Greenberg, Eli Broad fund. And now those guys wouldn't be putting money in to help Goldman out. They want to make money. That's not a bailout. So then they would bet the reversion to the mean again, as I said. The statistical arbitrage strategies spreads have widened so much that Goldman Sachs is betting that within a few months things will stabilize and the reversion to the mean will come back and they'll make the money. And they'll be doing press releases saying people should not have gotten out. When Goldman says to stay in, they mean it.
All right. Charles Gradante of Hennessy saying it's not a bailout. Appreciate it.
Not a bailout.
All right. Thank you very much. Emerging markets, international are working as well. All right, up next, Mattel's recall of nearly 20 million toys, sending the stock tumbling, down about 20% since April. We'll ask one Mattel investor if he plans to sell his shares, maybe buy more. Stick around.